So for example, the first year you have your mortgage,
Yeah.
the interest is calculated on the capital you own at the beginning, right? So which is a much bigger amount that when you're towards the end, let's say 20 years down the road,
Mm-hmm.
you to make things simple, if your interest rate is 5%, for example, I know these
Yeah.
days it's much, it's getting out there to be higher than that.
Yeah.
But let's say it's 5%. So 5% of $100,000 20 years from now will be much lower than 5% of 500,000 today, right? So
Right.
that's why at the beginning, to make your payments stable across this amortization period, your lender will charge you a lot more interest at the beginning, and
And
at the
then,
end it will be the same payment, but much more of that payment will go towards the capital to repay your debt.
okay.
And that's when it becomes really important, if you can afford it, to start accelerating your payments. So every month, right from the beginning, if you can put a bit more on your payments to accelerate that capital repayment, then
Yeah.
it will definitely reduce the time you need to repay your debt.
Okay. So thank you for clarifying that. So amortization